All right, we're live. Ready to dive into some Carvana today? Are we ready to continue where we last left off last week? We got Jason in the house again. Oh, always a pleasure having him here. Yeah, we got a nice turnout to start the show. I guess we should start the show a little bit later. Sorry everyone for the holdup, but that's on me this time around. I was running back from the suburbs, celebrating my granddad's birthday. Took longer than I thought to get home because Memorial Day traffic. What are you gonna do? So sorry about that. That's on me. Um, anyways, before we dive into our deep dive on Carvana, um, as always, like, comment, subscribe, all that great stuff goes a long way towards helping the channel. And we've got those discount links in the description below for Seeking Alpha and ShareSite. Seeking Alpha has a host of articles and resources on all of our favorite value stocks and those less favorited as well. So it's a great resource for some research, preliminary, or even deeper research as well. And then we have that discount link in the description. And then ShareSite portfolio tracker. We're using it to track the punch card portfolio, which I would say has seen better days, but it's never really seen a good day. But you can check out that portfolio as well. And you can track your own in there with a free account. We have a discount link if you want to use their premium subscription. So check those out in the Discords down there as well. With that out of the way, should we do we want to start with Carvana? Do we want to talk about anything else that's happened? I know we had BABA earnings recently, and that caused the stock to pop quite a bit, although it's still well below where it was not too long ago. Where do we want to start? Any preferences?
I think let's start with the WeWork of the WeWork of used cars. We can start there.
The WeWork of used cars, Carvana. That's going to ruffle some feathers in here. I believe, Jason, you're currently the only shareholder here that owns any Carvana. Is that right? Am I mistaken? Or you sound like a huge fan, Karan?
Yeah, I guess I am a shareholder. I put in 5% of my portfolio into Carvana, and I kind of keep that fixed portfolio publicly, but I also have money coming in, and all week long I was buying, and I'm getting more comfortable with the idea of going up to almost near 10%. I'm not there yet, but I'm comfortable with that. And so, yeah, I'm a proud shareholder of a company that's changing the world and saving families $1,000 per car and time when they buy a used vehicle. And the march continues. Back to you, Jack.
Sure.
That's what they say at the end of every intro in the earnings call.
Yeah, back to you. Right.
The march. One in the comments is buying Carvana, or is a shareholder.
Well, you guys have a really smart audience, and so I would imagine some of them are.
Well, you're not alone in it. You have some serious value investor votes of confidence, particularly with Rob Vinall and Cliff Sosin, right? So you have that's a serious vote of confidence right there from both of them.
Much higher price.
You're not alone. We'll say that, and I'm sure we have some others in our audience who have bought in. Though it is a bit of a polarizing stock because of a number of reasons, which we can dive into. But what in particular, if you can remind us, Jason, what drew you towards it? Was it really just a cloning thing to start with? Obviously, you did some research after that, but what's like the kind of bullet point sort of thesis in favor of Carvana?
Yeah, can you guys hear me okay on my computer?
Yeah, I can hear you. You're frozen.
Okay, I imagine in maybe 30 seconds that should wind down. But why don't you give me a second here and
sure. I'll bring it back in a second.
Oh, wait a second. It looks like
it's fine.
Yeah, it looks like you're back now.
Okay, I think I'm back. Sorry about that. Yeah, I got way too many tabs open. I think I was on here, last week, and I was trying to find the tab of our chat tonight, and I got confused because I had a whole nother browser open with last week's tabs, and StreamYard's still open. So
too much RAM at once.
Yeah, on a very good computer too. So yeah, what initially got me into it was seeing it pop up Cliff Sosin's 13F and kind of becoming familiar with his story with Carvana getting in very early. I've seen some YouTube videos with Cliff Sosin. There's a channel called Good Investing Talks, video from 2019 if you search Cliff Sosin Carvana. So I was aware of it. And then Rob Vinall putting it out in his letter and then putting out his letter publicly. That kind of sparked my interest, but I was still like, no, I don't get this at all. I really don't get it. But it was just trying to figure out why those guys wanted it and really thinking about it, kind of not understanding it at all, like in terms of how they would want it. That coincided with the price drop, and the massive price drop kind of caught my attention. And then I think I kind of figured it out at that point. And when it came down to the price drop, it just made it super easy for me. The stock has been in free fall, kind of stabilized in the last few days, but during the past month or 5 weeks or whatever, it was an absolute free fall. And it really made the situation easy for me to understand, because I was able to start thinking about it like, okay, a lot of the market thinks they're going to go bankrupt. And they obviously have a company that a lot of people want to use. And so it became a very easy thing to think about. Are they going to go bankrupt or not? And if they're not going to go bankrupt, then this is going to be like a multi-bagger. It just probably will be if they're not going to go bankrupt. And so that price drop kind of made it easier to think about. So that's kind of my story with Carvana.
Makes sense. And I do have to pull up SC358's comment here. What does Carvana do? You're breaking up. What was that guy on CNBC? I think it was when he was pretending like there was a breakup and he didn't understand the question.
Yeah.
I guarantee you, if we overlay that with the tech industry, stocks like PayPal and Peloton and stuff like that, not saying they're the same caliber company, but those companies in the S&P 500, that interview probably had to be within like 2% of the peak.
I wouldn't be surprised. Yeah, it was definitely
peak market territory.
Yeah. I forget who that was, but God, that was an iconic. Yeah, that might be the symbol of the peak right there. If this is in fact
totally,
or that was the peak.
I like the next question right after that comment. Like, how reduction in car price will affect?
Yeah, so if the used car market goes down, it's obviously been on a surge in the last couple of years, especially the last year. Used car prices have soared, which you would think would be a good thing for Carvana. Though then again, if they're trying to buy used cars, that's not so much of a good thing. So yeah, but I guess how do we reconcile that? Is that going to be good or bad?
That is, it's a good thing when prices are low for used cars for them. That's what they say on their earnings calls, and I think that's pretty much because they seems like they kind of make the same spread, or around the same spread, no matter what the price of the cars are. Like, that's a strong statement, and that's probably someone could pick that apart. But like, generally their business model is to make it easier for people to trade used cars with other people via them, being kind of the used car dealer, and they make a cut of that. And when prices are going up, I don't think they necessarily make a lot more money, but it can crush demand, which is what happened in the last quarter. And so they've been saying they like when car prices go down.
I think they make them money on the financing more than the actual sale of the cars, right?
That would make sense. Yeah.
Yeah, they break it down by like how much money they make on retail when they sell a car to a person, how much money they make on wholesale, which I think is less. And both of those numbers, I'm pretty sure, compared to CarMax, I'm pretty sure they're lower than what CarMax makes in each of those situations. But they make more on the financing, because I think they just package and sell those loans. They don't keep it on their books, and they don't make that money over time. They sell it, and that becomes a large part of this thing called I think it's gross margin per unit or something like that. And that's where they make a lot of money. And that's another thing that crushed them, is they were, in the last quarter, they were offering financing at a certain rate, and then the rate that they could go. The new rates that were in the market when they went to sell it had raised on them, and so their spread was smaller. And so one of the things they say is like, okay, we're going to adjust to that over time and have higher rates that we give to customers, and we won't get hit by that again. So there was a lot of, if you believe it, if you agree with it, there was a lot of crazy one-time stuff that happened to them. and obviously I think they're going to make it. But that's kind of one of the reasons why they've been crushed recently with that quarter.
Well, I mean, they have been on a surge. Here's the revenue numbers. You mentioned gross margins, though, which are pretty low, all things considered. I mean, just recently in 2021, 15%. Last 12 months, falling down to about 13%. So they don't have a huge amount of room. This is gross margins right here.
If we shift to the cash flow statement, that's when things start getting a lot more.
Yeah, we don't really have to go over there. why don't we go to that page in like 10 years? We'll do a follow-up.
Well, let's take a look at those cash flows because it's a little yucky.
But 10 years it might not exist, so might as well go through it while we can.
What's the debt situation again? Because you have deep negative cash flow. Can they just keep taking on debt to weather the storm, diluting shareholders?
A fair statement is to say that probably the vast majority of companies in the S&P 500 do have debt, so they're not an outlier there. And
of course, I'm really talking about a substantial debt load.
So actually, honestly, they didn't really have. I don't think like a ton of debt. I think it might have been like around $2 billion. And then what happened is they bought this company called Odessa which is it was a unit of another company, and they bought it for $2 billion, and to buy it they issued debt, and so they bought it for $2 billion. We can talk about it, but essentially it's a land grab. It's like 56 locations around the United States that are already zoned for car auctions and used cars to have on the lot there. Gets them a lot closer to customers. That's going to be $2 billion. They did it with mostly debt financing, and then on top of that, they asked for another $1 billion from the markets to spend on reconditioning or getting those Odessa land areas ready for these reconditioning centers. And then they kind of said, well, we're going to use it for that to improve this land and make it more valuable to us and what we need to do. But we're also going to use it for general corporate purposes, that part of that last $1 billion. And the market didn't like that either. And on the earnings call, they said, well, obviously things are choppy right now. If we can get some money and keep some cash around, we're going to do it. But yeah, I think it might be around $5 billion of debt, I think, after this transaction, but somewhere around there. But they also have a lot of land that doesn't have a debt against it. They have cash. And that's the question, is if they can make it.
It's not too much cash, all things considered. About 600 million. It's something.
I think that might be. I think it's going to be more now because they took on a bunch of that debt.
Sure. Oh, true.
All of that is super recent.
Yeah.
What were you saying, Tom?
Tom, what were you saying?
Yeah, I think I'm on a big lag here. I had a couple of questions, Jason. The first one is basically how have you gone about trying to value something like Carvana? And I guess the debt is one part of it, but I also see, if you've still got ticker up, Jack, there's been some pretty crazy compounded growth rates of shares outstanding as well. So presumably that's their other kind of big source of capital. Just wondering how you think about that.
Sorry, Tom, I was reading something. I got the first question about
he's asking about dilution. Here are their shares outstanding.
Oh, the dilution. Yeah, I mean they just so with dilution they're a company that's been growing, and that's the reason why they've had to dilute, which I'm not worried about that at all. And then just recently I think they issued another can't remember the exact number, but a portion of all this new financing was issuing shares at $80 a share. And the father and the son owners, the founders, they bought a lot of that stock at $80 to fund money into the company.
Get the last few quarters of shares.
And then Tom, what was the other question?
How are you going about valuing Carvana?
Oh yeah, so I'm kind of looking at it two ways. It's very different than like my normal kind of investing where I'll put like 20-30% into one position if I really feel like there's no downside or super limited chance of a downside. or even if a downside happens, like it's not a big deal at all. Like I just bought a bunch of Alphabet. I made that a 30+% position. Not worried about wipeout at all. But in this case, I'm keeping it a very small, possibly speculative position. And I'm going to cap it at 10%, at least right now, because valuing it, I'm looking at the upside, I'm looking at the downside. On the downside, I'm looking at the risk of wipeout. I don't know if it's a 1% risk or a 50% risk or an 80% risk. I just know it's on the table. And I say it's on the table because I see that they've raised some money. It doesn't look like they're going to go bankrupt tomorrow or anything. But in this space, used car dealers, when financing is such a big part of it, you look around the world, the macro is kind of crazy right now. If something really bad happens to interest rates, if we have a 1980 and the Fed rate goes to 20% and people don't buy cars for 2 or 3 years, or if there's a war in a part of the world that makes most of the chips in the world and actual car companies can't build cars for a few years and prices skyrocket because there's a lack of supply and a lack of used cars, they don't make money right now. And their ability to go to capital markets is somewhat shaky because it didn't go as smoothly as they wanted on this Odessa transaction. And if interest rates go up, they might not be able to get money again. So there is a risk of wipeout. I don't know what it is, but the upside to go to the other way I'm looking at it is so massive, so absolutely massive. I think it could be a 10 to 50 to 100 bagger. And I add on the fact that I'm cloning to this and I'm like, okay, I want to do it. And on the upside, it's like you look at the used car market, 40 million cars a year in the US, their market share is 1% right now. You look at their market share in some of the cohorts or markets they've been in the longest, like Atlanta, it's getting up to like 3.5 or 4%, something like that. And if you think about it, like this is the Cliff Sosin video on YouTube, in 10, 15 years, when like they could have a chance of being a platform, they could have a chance of taking a 30% market share. And when you run the numbers, 12 million cars making 1,000 to 2,000 of profit per car, you're talking like 10, 20, 20 billion of net profit. You put a multiplier of that by 20, and we could be looking at 50 to 100 bagger, plus opportunities like turning their website into a platform like Amazon, third-party sellers and stuff. So it's just, I'm not really doing like, oh, I think it's worth this today or that today. It's more of there's a downside. I know there's a downside. That's why I'm keeping my position small, but the upside is massive. And I actually feel better about my ability to judge the upside than I do with my ability to judge the chances of the worst happening or a really bad thing happening.
One thing I will say, you mentioned like if there were a massive chip shortage, like even worse than now for conflict or for whatever reason.
Yeah.
I would imagine that would hurt new cars a lot more, and that a used car dealer like Carvana or all the others would be in a much better position because now new cars would be so much more expensive, or if they could even make them at the same quality. So wouldn't that actually go to help the used car market?
My understanding of it, it's kind of like my position on this show. So I'm kind of like the used, beat up 10-year-old car. And as soon as one of the greats wants to be on
reliable,
here, like Brad,
though, Jason, reliable,
reliable, and that's why I have some value to me. But I'm a used car, and you got someone like Tom. He's not here every week. He's buying a house, whatever. You got Brad out there. Some weeks he's here, some weeks he's not. But as soon as the legends want to say, "Hey, I'm coming in this week," they just kick me to the curb. And that's what happens with used cars. New cars come into the market. They come off the line in Detroit or Germany or wherever, Japan. They fill up the market with new cars. People who want to buy a new car go buy a new car, and then all of a sudden there's more used cars. And so I think what we've seen with the chip shortage, my understanding of it, and the reason why used car prices went up is supply and demand. If there's less new cars, then there's less used cars available, because that push of current cars becoming used cars when people go buy new cars, that slows down because there's not as many new cars to buy. Therefore, there's less used cars. If there's less used cars, less supply, but the same demand for used cars, the prices go up. So prices going up aren't really good for Carvana. And then they need to sell cars, and it's a very competitive market. They only have 1% of it. And if there's a crunch of cars, and by the way, it's not like they have one lot on a bad part of town that they just need to fill up with 200 cars and they'll make money. They need scale to run this kind of business. And if there's a limited supply of used cars because they're not making new cars because we have a chip shortage or a total chip elimination, if there's a crazy war, they'd probably be somewhat toast, I think.
I don't know. I don't know about. See, I would think I get they're in growth mode, so used cars becoming more expensive is going to hurt that effort. But if they're reaching some X market share and it's going to be hard to grow beyond that, it seems like used car prices going up would be a good thing for them. That would imply that new car prices are also going up, or something's going on there, which is their real competition. The used car market is competing with the new car market all the time. And right now, because it's harder to create new cars because of the chip shortage and many other things, you would think something like a Carvana would be in a great position, because then they can make a premium, make more on loan fees because the loans are bigger, whatever. But if they're in growth mode where they're trying to buy more cars, then that's going to hurt them on the other side. So I guess my question is, how much are they looking to grow beyond this? Are they trying to stop spending soon, or are they slowing that growth now, trying to reach a more mature stage?
Well, they just changed that mindset because they had to, and so they put out something on their website called the update on. Hang on one second. I'm too zoomed into it, but they did an update on Carvana operating plan May 2022, and basically they've been in growth mode where they spend money on new markets, building them out 6 to 12 months before they even sell cars there. They're spending advertising money in markets they don't even sell cars in yet to try to grow. They're staffing their reconditioning centers and all that. And so if there's a lack of demand because prices go up, that hurts them in the current markets and new markets. And so they've had to pull back. And basically all this 25 or whatever page operating plan, it just basically says we're going to, we've laid off some people. I think 2,500 people. We're going to get so this thing of GPU, gross profit per unit. They make money right now on a gross profit per unit basis. That's what that 15% gross margin was on Ticker. But right. The SG&A, what is that? Selling, general, and administrative. The other cost, that's really high right now. And they're saying that they have the ability to pull that down to meet the current demand and be self-sustaining and not have to go back to capital markets because they can make EBITDA and make cash flow. So that's what this plan is. I buy the plan. I buy it enough to want to be in there and try to be there when there's an upside one day. And even some of the analysts are saying that, well, Carvana's in a show me state now. It's in a show me position. Yeah, we think they can get there, but we're not really going to recommend their stock until they prove this. But I'm thinking like, well, once they prove it, the price is going to go up. I'm going to miss the opportunity. But they are trying to pull back and focus on cash flow and being self-sustaining now, so they don't have to rely on capital markets like they did with this Odessa purchase.
How much do they have to scale back to do that? Or maybe not scale back, but
Jack and Karan, is Carvana something that is of interest to you guys?
I have not been to this point, mainly because of the massive cash burn right now.
But you are a smart investor, Jack, and you are someone who's very diversified. And if there was a little sliver of your portfolio, a 1%, 1.5%, 2.5% position that could become worth 50 times what it is one day, do you see that upside?
Well, I appreciate the compliments, but it's hard for me to weigh it, given that they haven't shown. So here's one thing that I'm definitely worried about. First off, I haven't really looked too much into the history of potential fraud with the dad of the CEO. I know that's a thing, but we could talk about that.
Alleged fraud, right? It's not.
Or what? There's something shady. I haven't looked too much into it, and it sounds concerning. But that aside, the used car market was incredible for sellers in the last couple of years. So if if they've been increasing their losses over the last couple of years, that has me concerned. And given that their gross margins are already pretty low,
Yeah. Well, let me
just a combination of those factors.
You're a cautious guy. You're looking on the downside, and
right.
I appreciate that. So to meet that concern, if we could turn to page 6, where I could show you how they've been demonstrating their operating leverage. So this is exactly what the game has been. We're going to spend money. We're going to have losses. We're going to grow, but we have operating leverage. Tom would know about this with his famous investment in Fiat Chrysler, operating leverage. You have a bunch of fixed costs, but then your variable costs are low. And as long as there's demand, as long as there's a lot of revenue, you can make money. What I want to point you to is this EBITDA margin chart. They were marching up.
Isn't EBITDA a swear word in this space?
It is with 90% of my portfolio.
True.
Yes. But so the point is they've been able to show that they can get closer to making, one day, if you have enough EBITDA, it can turn into a net profit. And even if you want to talk net profit and kind of be old school like that, look at that chart there, 28% loss in 2015. We're demonstrating operating leverage. We're selling more vehicles. Our fixed costs are growing slower than our revenue, and we can, all that variable income, which is more than the variable cost, can come in, and we got our losses up to negative 2.2%. So yeah, 2020 and 21, they accelerated things with the pandemic and people buying online. But I think my take is that's kind of the future. That's what it will, I think, to a large extent, look like 10, 20 years out. So
I think Rob Vinal was kind of contradicting himself with Carvana, because he said one of the advantages that Carvana has over CarMax is the fact that they're online only, right? So CarMax has both. They have online and physical. But now with the acquisition of Odessa, whatever, they've gone into physical and into online. So, they're kind of pivoting backwards.
Well, so with Odessa, they're going to make something like $100 million of EBITDA a year from whatever this auction service is that Odessa does. But that was more of a land grab. And the way they've talked about it is we need more of these. Customers are not going to visit those centers. Those are going to be these, whatever they call them, reconditioning centers.
The physical auctions over there.
Yeah, that's Odessa's business, and that's part of what they bought. But more so, I think the reason why they bought that is the land. And they looked at it like, we need this land to build these reconditioning centers and be closer to our customers so we can offer more selection and get it to them quicker, which is why people buy, and take the cost off the transportation. So they needed this land, and their options were to go, and then I'm getting this from the CEO on the earnings calls and interviews and stuff. Their options were to go out there and buy the land and find it, and then try to zone it and all that kind of stuff, or just do it quicker and do it this way. And they said this way made more sense. And I kind of get that, because if you're trying to go into a place like New Jersey or a place like New York City or Chicago land, all that real estate is already filled in with businesses, and it's already zoned the way it's zoned, and trying to get that land that's close to customers for having a lot with a bunch of used cars on it, that to me seems tough. And they would have to go outside, way outside the city centers, and have a worse land position. So that's why they kind of quote unquote went into land, but they're going to need land anyway. It's just a matter of like, what is on the land? Are we spending it on like labor that reconditions these cars and we get them back to customers? Or is it like a car dealership or a CarMax, where we've got, in Rob Vinal's, to paraphrase him, little stores with little people running around trying to sell things? So
I don't know. The acquisition seems more like a distraction at this point. It kind of seems like here's something to let investors, be distracted by. That's what it seems like to me. Like, again, your perspective is it's for the land. I don't really, I can see that point of view, but it seems more like it's just it's distraction. It's like, the Carvana business is going to continue to lose money. Look at this other small business that we have that's generating a little bit of profit. It's got assets. Focus on this, so they probably can borrow a lot more against that in the future, and then continue to lose money on Carvana.
I'm taking them, or I'm in agreement with the management here. I see it. I see the vision, and I'm seeing the vision of, no, this was a master stroke, in my opinion. Like, this was, we're going to look back when this company has 10, 15, 20% of the market here in 10, 20 years or more, and say, wow, that land grab gave them a competitive advantage over a bunch of people in the industry. And so to me, it makes sense. But I think
that's what the discrepancy is.
I was going to say, Carvana, the majority of the market obviously has agreed with you over the last 3 months, because a lot of the stock price fell around this acquisition time.
But that's what, the stock price means nothing. Like, if it makes sense, the insight is why we get the returns that we get, right? Of course.
Well, yeah, and the stock price, it can give us a better opportunity as well if you like the position. I saw a hilarious article this week in Bloomberg, an opinion article. And they wrote about Cliff Sosin and Carvana. He was part of it, but the point of this opinion article was, hedge fund guys, it takes so much to get them to say sorry or that they messed up, and that they won't admit it. And one of the things this guy said was now there is truth in price. Now price is telling us all the truth. And that's the exact opposite of what Ben Graham said, that price doesn't matter. It's the actual business. But so it's a crazy time and crazy opinions out there.
You're always going to get stuff like that in either direction.
Yeah. I don't know.
This guy took a shot. Yeah.
Real quick, I can pull up kind of a map of the ADESA deal. Here's a quick plug for Seeking Alpha. I will note that it does say that, warning, Carvana is at a high risk of performing badly. Thanks, Seeking Alpha. Well, anyways, one cool thing about Seeking Alpha is they curate a bunch of content, and this is from writers, funds, all sorts of people can write about this. They submit it to Seeking Alpha. They'll approve those articles that meet their mark. And it's a really good way, I think, to get some kind of preliminary research going, especially on kind of more recent news. So I like using Seeking Alpha for that. So again, we have our link in the description, but they have this article right here about the ADESA deal. I was just looking at a map.
Jack, can I just throw something out about Seeking Alpha?
Go for it.
A Cliff Sosin interview where someone asked him, how do you do research and that sort of thing? And he said he likes walking around and listening to the last 4 quarters on the earnings calls. And he said you can really hear the story if you listen to those 4 in a row, going back to the 4th one and then forward. You can kind of hear the story of the business over time, over the last year, and get caught up. And on Seeking Alpha, they post the transcripts and the audio if you subscribe to a certain level. And that's one of the main reasons I use Seeking Alpha. It's a tremendous asset, and I did that with Carvana. Yeah,
it's good just to kind of get your basic information to get going on further research, maybe hear about something that you might not have heard of. So, but yeah, good point on the transcripts. I totally forgot about that. I do use it for that as well. Because often it's hard to find if a company they'll do their earnings call and then the recording will disappear. So you got to find a transcript somewhere. So it is helpful for that. Yeah.
Look at that beautiful map.
It is beautiful. I'm a real estate guy, so I love maps.
I was just saying that, Jack. Yeah.
It's great.
So when people question you when you're out there making videos about why you took a 7% in Carvana, 7% position, you can say it's essentially a land deal that you got into.
It's these maps. It's a real estate deal. just all the way through. Forget the cars. This is
Heritage 2.0.
Yeah, it's a What was the Peter Lynch golf course deal? Whatever that one was, I totally forget the name. But anyways, yeah.
Carvana spent 2.5 billion, right, on ADESA?
Yeah.
Should have just gone with Seritage.
Or two, maybe a little under. What did you say, Karan? Seritage?
I should have just gone with Seritage. 2.5 billion.
I could have worked. I think that the reason that's honestly that would not be the worst thing, because they could put those vending machines in the prime spots and all that, but that land is not zoned for cars to be on it. And there's a lot of that's very hard to do in parts of this country, get stuff changed like that. And I saw something came out recently that said Amazon is now subleasing their warehouses that they don't need because they have more warehouses than demand. And I thought, oh boy, that's not good for Seritage, because one of the theories I had on Seritage was that someone like Amazon who needs space could just buy Seritage outright, but it doesn't sound like that's going to happen. But good luck to everyone in Seritage.
Oh, Jeremy has me covered. It's Pebble Beach. Pebble Beach was the Peter Lynch golf course deal. Thank you. Should we talk about? There's two other things with Carvana that get me concerned. One is regulations. I know they actually had some pretty positive news today. That's why it popped like 8 or 9% today. But I think they've run into some pretty strong headwinds on the cars they're selling. I don't know. They don't have clean title on them or something, or there's some sort of issue in some states that they're running into. I haven't looked too closely into it, but I know that is a thing that is going on, and they had some positive news in my home state of Illinois today. So any thoughts or insight on that? Again, I'm not too familiar with it. All I know is it is a problem.
So we're building a moat here at Carvana. We're doing really hard things. And when you do hard things at scale, stuff's going to happen.
Of course.
And dealing with, like I came to understand recently on an earnings call, it's not like in some cases, I think there's Carvana employees dealing with the state title offices and all that. But in other cases, they use like third parties. And basically, it's just, it's not good, but it's a symptom of growth. And they were growing so fast through the pandemic. Demand picked up so much more than they expected, combined with Omicron and people calling out, and not only calling out of their company, but people being off sick or not working with the title offices and the third parties and all that kind of stuff. And then just people, I think my theory is working from home and just the pandemic. A lot of it was hard to get a lot of this paper pushed back and forth, and I was worried about that as well before I was a shareholder. But I came to kind of look at it is like, well, wait a second. And again, this could be the upside clouding everything, but the way I rationalize this is it's a symptom of growth. When I see that, yeah, it does make me, as a personal consumer for myself, worried about buying a car from a company that has those issues. It turns me off. It lessens my demand, but it doesn't lessen everybody's demand. And despite that, those problems going on, despite that being on the local news and the markets where that happens, they still have the demand growth for the most part, except the last quarter. And they fix it. Like just you were saying the news today, I didn't realize that, but it sounds like they're okay in Illinois now.
Or sort of. Here's the
Are they under probation or something?
In Skokie, right next door to me. I guess they had their dealer's license suspended, so they couldn't sell, and that has now been reenacted, but with restrictions, I guess. Oh, we have a super chat we'll get to in just a second. But yeah, the company is allowed to sell vehicles to Illinoisans, but can't issue temporary registration permits or license plates during the stay order. I guess they're waiting for like some sort of final with their title transaction. So it is something with having clean title, I guess, on these cars.
It's been an issue.
Yeah. So, but it is positive news for sure. Better than not being able to sell anything. Here, real quick, let's detour with this super chat. Thank you, we appreciate it. Any thoughts on electrification technologies? Will it cause as much disruption as the internet technologies? Also, KPG, please. Our resident KPG investor is not here, but let's start with that first one on electrification.
Is he talking about solar? Is he talking about batteries? Is he talking about?
I'd imagine cars, given that that's the ballpark we're in, but I guess in general too.
Maybe.
It's all kind of part of the same ecosystem, right? Just kind of, solar going into batteries, going into cars and other things.
I don't know. The only company that seemed very interesting in that space is probably Enphase. Enphase is interesting. But then again, like,
Tesla is interesting too, but we know about Tesla.
Exceptionally cheap,
Yeah.
I heard, Jack.
Yeah. I mean, I did my analysis a few months ago now.
guys, do you think Tesla could get back to like March 2020 lows, like $100 per share?
I'm wondering if we're seeing the Amazon event taking place, like we saw in the tech bubble with Amazon, Microsoft, and others, that when they went on ludicrous runs and then fall like 90%, but then end up, over the next 20 years, slowly marching back up. I could definitely see that happening, but I don't know. We're still very early. It could easily jump right back up to 1,000. Crazier things have happened.
Yeah, I mean, Tesla. Yeah, Tesla. If I think I'm right in saying that they have net cash. Maybe that's not right. We might have to check that. But I mean, Tesla's got a lot of their capex out of the way, and they're a profitable company.
Yeah, they're not going to disappear.
I don't know that they're going to be a
does.
.com 2.0 down 90%. But I've been wrong before, so we'll see.
Yeah. But I mean, like in the .com bubble, Microsoft was a profitable company. It wasn't going anywhere, but its stock valuation got away from fundamentals. So
I think it depends how high you think it is now compared to the business and the business's future.
Of course. But lots of things can happen. But as for, I guess, the more general question on how big of an impact it will have, it seems like it'll have a pretty big impact on fossil fuel industry, because it seems like there's sort of this political regulatory movement to go towards something like this, which would mean that supply for a lot of these fossil fuels might be getting constrained artificially, which, I mean, that's going to have a ripple effect everywhere. Energy might be more expensive for a while as you make this transition to electrification. It's hard to say exactly. This is really kind of a macro call, so a lot of things can happen, but let's just say it's going to affect the energy market. That's my bold take right there.
I was looking at it.
Right.
I was looking at it from a car perspective with Carvana, with electrification, because that is one thing I am worried about. Like, what do cars look like 15 years from now? If that's the theory with Carvana, is I'm buying it for 20 years from now. What does electrification do to cars? I don't really know. I think someone asked Rob Vinall that at his annual meeting video that's on YouTube, I believe. And I think he said they're selling Teslas. So I went to Carvana and I just typed in Tesla. Just want to point out two things. It looks like there's 23 pages of Teslas, or 21 pages that are available. And I could get a Tesla delivered to my driveway in 4 days in some cases. Pretty cool.
It does seem like a real nice service. I'm looking to buy another car this summer, and Carvana is definitely going to be on the list because the service does seem really nice.
You can do like a Peter Lynch, try out the product.
Yeah, right. Yeah. Explore it a little bit. But
even in terms of
any rapid fire thoughts on KPG? We got another super chat to get to.
Can I say something about KPG?
Of course.
There's a man with the last name Kelly who runs KPG, if I'm not mistaken. Brett Kelly, maybe.
Yep.
When I was on Twitter, I'm not on Twitter anymore, but when I was on Twitter, I followed him, and he said something to the effect of a few weeks ago, look at all this accounting market in the United States. What a beautiful market, or something like that. And it got me thinking, like, oh my gosh, is this guy going to do the roll up of not only Australian accounting firms, but also the United States? So who knows if he's just tweeting something. But as far as KPG, I had never thought about them outside of Australia before. I don't even know if that would be a real thing, but maybe it is, and that got me a little curious to take a look at them.
I wonder how consolidated the U.S. accounting market is compared to Australia. I wonder if it's bigger or more consolidated, that is, with like the big four accounting firms. But there are tons of little small shops, which is
I think it's the small shops with the small businesses.
Yeah. That would be something, but
I actually asked Brett a similar question in line at the Berkshire meeting. I asked him
when
if
I
he
was just hanging around,
which I imagine is a
rubbing elbows.
I imagine is a much smaller market opportunity than the US. But he gave an interesting answer. I mean, he basically said, maybe at some point, but he sort of wants to dominate a particular region and then kind of look to expand. So they've been extremely focused on Sydney, for example, for the past 15 years at this point. And they could still do a lot of growing, I think, in Sydney, like one city in Australia. So I don't expect them to suddenly turn around and launch into the US tomorrow.
Yeah,
So,
I think it would be putting the cart before the horse. Like, just keep focusing on what you're doing well and what's in your backyard before you go crazy. Because then you might get some of the growing pains that something like Carvana has faced. Go ahead, Tom.
Yeah, there is zero requirement for KPG to go to the US anytime soon for them to keep growing at like easy double-digit rates.
Yeah.
Tom, can I ask you a question about KPG? It is the number one stock that I think about.
Yeah,
where
and my other hot take on.
We got some lag.
Sorry, Tom, a little lag.
Tom, yeah.
So my question for Tom when it gets there is KPG is the one stock that I kind of kick myself almost every week, and I think, wow, I really am an idiot for not looking into that. That could be a huge win if I take some time to look into it. Do you think that's a valid concern? Like, do you think there's a lot of opportunity here with KPG still available for shareholders or new shareholders?
Definitely.
Okay. Close to
Jason,
the vest.
like, I'm kicking myself because Frank was pitching KPG to me when it was like 91 cents, like around that price. That's when he was buying. And that's when he had pitched it to all of us. And we were all just like sitting on our hands and like, oh, okay, you have an accounting business? Great.
Wow. So now it's at $3.55 Australia. And it looks like in the last year, it's come down from 5.30. So it's down 33%. So I'm going to take a look this week.
All right.
Yeah, I've been rereading a lot of the reports on KPG just the last day or two. So hopefully the punch card portfolio won't like me saying this, but I'm crossing my fingers that it goes down a lot and I can do something there.
As long as it doesn't join the rest of us at negative 40%, like, it's all good.
It'd be really funny if you guys just turned on him. And I know you have some kind of voting
complaints
system.
from me.
I know you have some kind of voting system where you can get rid of a stock if enough of you vote for it. That'd be funny if all you just said, no, we don't want this anymore.
No, we don't pick who gets kicked out.
We don't pick it.
Yeah, the people pick that.
Okay,
we pick if a stock gets added. So let's say we wanted to add Carvana today, then the people get to vote on what gets removed. We were really close on Facebook a while back, which I think is lower than where it was when we voted last. So that I don't know if we bring that one up for a vote again soon if something happens. Or
trying to think how. I mean, it was dumb to buy Facebook, but it might be even dumber to sell Facebook. I can't figure that out. But I'm trying to put myself in the shoes. If I was dumb enough to buy it and it had fallen, where would I be now?
I bought a bit more when it hit 180 again. So that's been the one I've been adding the most over the last couple of months. But I am I'm building up a bit more of a cash position, getting ready to buy some real estate, buy a new house soon. So just have a little bit of reserves ready to go.
Definitely.
All right, we have another super chat, which I promised to get to from one of our resident Carvana bears, lazy investor. One $10 share to recoup your losses on Carvana. The road of a contrarian investor is lonely, my friend. Stay strong. Best of luck. That's some encouraging words from a Carvana bear. So thank you, lazy investor. It can be lonely, especially in the value space. It's an inherently contrarian thing. You're saying that the market is wrong, and the market is technically most people. So you're inevitably in the minority of investors when you're a value investor, at least in the way that we think about it.
It's so interesting with Carvana, if I'm reading this comment right, where a lot of people are down. I mean, a lot of people are down 85, 90% on Carvana, 80% if they bought it 300 something. And I bought it 30 something. So it's not like I was buying it when it was high,
Well, no, but you're buying as it's free falling. So more people are selling. The volume is indicating that more people are selling than buying. So that's contrarian when you go ahead and buy when it's falling. It was a
contrarian move, even though it fell to You didn't feel that brave given how much it had fallen.
That's because of the way you're wired.
Yeah.
You're wired like a value investor.
It's true.
But thank you, lazy investor.
How does that super
he
chat thing
long
work
stone?
out for a guy that's on maybe 1 out of every 5 episodes? I'm just curious. Or it doesn't work out.
Say what now? How does it
No,
work
I'm just
out?
kidding. No, I put
You're
put
propping
my,
up the super chat
Yeah,
market.
I shouldn't have gotten involved with that. I'm sorry. I just saw a few dollars and
We have some great friendly supporters.
Jason,
here.
I don't know if we've ever taken money out of the Punch Card channel. It's a loss leader for us.
I hear you.
Yeah, we StreamYard fees are coming up. I think we pay them in July, so that we'll see how much we have left over after that. I think we'll have something left over this time, Tom. We'll see.
You might have like $2-3 each.
Yeah, we could buy a slice of pizza for one of us.
Yeah.
Maybe after inflation, maybe half a slice of pizza.
You guys should
After
do
pizza.
whoever has the best performing stock in a quarter should get that quarterly profit, whatever the contribution was to the portfolio.
Mess up the incentives a bit, huh?
Yeah. Or the year we can
Yeah, that helps a little bit.
open it up. Yeah.
Jason, if you had to add one company to the Punch Card portfolio, would it be Carvana? would you like-
If I was a 25% position or sorry, 20% position,
20%.
no, I wouldn't add a 20. I would not add a 20 Carvana for a 20% position.
Okay,
It
now
would be too
Jason,
big.
I got to ask because I know a while back you talked about the full position rule. Was it
The Brad-
10%? Was
The
that
Brad
like,
bar.
The Brad bar.
the bread bar? Yes, of course. How
Yeah.
did I forget the name? The
High
bread
protein.
bar. How do you reconcile that? I know. Have you kind of
It was a
tabled that for
great
this,
name.
or-
It was a great name, but a horrible idea. I was just thinking about it the other day. It was a horrible way to think, a horrible idea. So I don't have that rule
I don't
anymore.
know if it's horrible. What
Well,
makes you
it's
say that?
horrible if you're open to having positions that are smaller than 20%. If you only want positions that are 20% or larger, then yeah, asking yourself, would I be comfortable if this thing was 20% of my portfolio makes sense. But if I take the last 10% of my portfolio for more speculation, it just doesn't fit with this kind of stuff.
What about what if you is that just because the Brad bar was a little bit too high? Maybe you lower it down to a Guy Spear bar of 10% or something like that.
I don't know. I do the Guy Spear thing of trying to feel. What's funny, Tom, is I always say water coming up to whatever part of your body. I rewatched the interview because probably rewatch one of your videos every single day, Tom. That might sound a little weird, but I watch your videos every day.
I try to
Tom.
watch yours, but they've disappeared, Jason.
Yeah, Jason,
Yeah,
you got to explain
you know.
yourself. You got to explain yourself.
Okay, so all right, we'll save that.
Maybe
for
let
later.
the people know. Yeah.
Yeah, we'll save that for later if you guys remind me. But I watch Tom's videos every single day. First thing I do when I wake up, and the last thing I do, I put the phone next to the pillow next to me. I have 2 pillows on my bed, one for me, one for
I don't want to hear
Tom's
the rest of
videos.
the story.
One for Tom.
and then I fade off. And so I was the one I was rewatching this morning when I woke up was the Guy Spear interview. And he actually never said water, which is so funny. He just said the feeling of being over his head or something. But I use that metaphor, that analogy, and I just try to think about like, where do I feel comfortable? For me, I think about water and Carvana at 5 or 10%. I kind of feel at my calves and ankles, and I feel fine, But that's kind of what I do with allocation now. But I like the Brad bar rule for people who are doing huge positions only.
Jason, I think one of the most interesting things about this entire discussion, because for me, Carvana is just easy to put in the too hard basket, and I get some of the aspects of how it could be a huge home run, if it continues to scale well and that sort of thing. But I think one of the most interesting things here is how you've thought about position sizing. Because I know you're comfortable taking 20, kind of 30% bets, particularly if I guess the odds are maybe simpler to understand, or you understand the downside better.
The downside,
and with
yeah.
Carvana, there's this huge wide range of outcomes. I'm just wondering what your kind of thought process is there. Like, why is it? I'm not sure exactly where it's at now, but why is it say 5% instead of 1% or instead of 20%?
Well, 1%. when I think about 1% and that going up 100 times, I mean, you double your money, but it's not really life changing or anything. So it just feels too small. And then when I think about risk at 1% versus 5%, I feel fine at 5%. I'd feel obviously better at 1%, but I don't feel like the upside is big enough. And then the reason it's not quote unquote like a real position or a huge position is purely the downside. I just put 35% into Google, to Alphabet. Unless things happen in the world that are going to be horrible for me, like I don't even want to say them, but war and stuff like real war, like nuclear and all that kind of stuff, I think Google's going to make it. And I looked at Google like how much cash they have net of debt versus what their expenses are just to open up the business, even at full employment and all that kind of stuff. They could run for 3 years with $0 of revenue. So even if there is a recession and advertising spend drops, they're not going out of business. And so it's all about downside for me, all about downside with allocation size. And with Carvana, I could see a scenario like I laid out earlier, horrible recession or horrible war that wipes out the used car market, and they go to either down by half or to zero. So that determines my allocation.
And if a company came along hypothetically that had Google downside and Carvana upside, how would you size that?
If a situation came down that had Carvana's upside with Google's downside, well, I don't want to sound like a jerk, like an a-hole, by saying 75%, but I mean, if something like that came along, and you really knew it, and you knew there was no downside, for me, I'd probably be asking myself if I had the courage to go to 75%, maybe higher, but like the 75% is the number that Buffett and Munger gave at one of their annual meetings, where Buffett said, if you're not him running a huge company, but like a small investor, or an investor, and at some point in your career, or a couple times in your career, you're not 75% into one thing, you probably made a mistake. He said that. I don't know if he would say that now, but that was like 2008 or 2009. And yeah, I mean, if you had that kind of upside with no downside, which I don't think there's a downside with like a wipeout risk with Google, or even a permanent loss of any capital at the current prices. But that's my opinion.
I think Munger would say. Sorry, Karan. I was just going to say quickly, I think Munger would give a similar answer about if you're not 70% in one position, then
75,
75. What are you doing? But I think in practice, Munger would be like 130% in that position. He's just saying 75 for the interview to be considered.
And if Munger was not already a billionaire, if Munger was someone coming up with a long runway of earnings ahead of them and a big desire to get rich, I'm sure he might do something along those lines. And he essentially did with the apartment complex early in his career, his first big move. I'm sure he was heavily indebted with that.
He did with British Columbia Power as like a merger arbitrage. I think he was like north of 100%. That was written about in the Snowball.
Right. I remember you talking about that recently. I think 2 days ago I was listening to that one on the nighttime session. Yeah.
Nice.
What were we saying, Karan?
Justin, have you looked at Bosch Health?
No, I saw someone mention that the other day. I don't know who it was, but someone mentioned
I was asking people for write-ups. But take a look. I think you might find it interesting. Like it's a special situation. It's PHC. Not going to really talk much about it, but
I'll have to look at that.
Yeah,
saw someone talking about that.
It's literally trading at discount to the value of.
I saw Bill Miller talking about it. There was
an
amazing interview with William Green and Bill Miller, and he's doing great except for these margin calls. He keeps saying, he's like, William Green's like, is it painful right now? And he's like, no, it's not painful. It's just these margin calls are really annoying.
That's when you know you have enough money.
Yeah.
That's where that's where I heard about the idea first. But
man, you guys, that interview, for anyone who wants to understand how to deal with this current market environment, that was so timely. I think. I mean, the guy seems to be very risk tolerant when he thinks he's right about positions. Could I just throw out one more thing about Carvana?
Let's do it.
So you have just recently there's been some insider buying. One director increased his position at $104 a share, $105 a share for a 50% increase, 54%, 2.6 million. The son, the CEO, Ernie Garcia III, put in 160 million, increased his holding by 331% on the $80 issue. They recently issued shares. The father increased his holding by 400 million at $80. And then Dan Quayle, former vice president of the United States, director, increased his holding by 200%, 700,000. And then recently, I think it's another director put in like 800, almost 900,000, I think, or something like that. So there is a clone aspect to that as well. I bought at prices a lot lower than insiders. Bought at prices a lot lower than super investors. And just wanted to throw that out there.
Cool. Something else I just wanted to randomly throw out there, completely unrelated to this discussion, is that because some of you probably know I follow the milk and infant formula space a little bit with one of my holdings. And there's been like this infant formula shortage in the US, which has been kind of interesting to follow from over here.
I think you mentioned this before the show, right?
Yeah. And so Joe Biden put out a tweet like 9 hours ago saying the US is about to get 27.5 million bottles of infant formula from Bubs Australia. Now, I have no investment in Bubs Australia or anything, but they are a public company on the ASX.
Oh, wow.
And I don't know what they sell a bottle of milk for, but if they're selling like close to 30 million, that is pretty significant because their full year's revenue for 2021 was $39 million. So that might be an interesting one to watch on Monday. I don't know the details. I've just seen this tweet, but that could be a fun stock price to check on Monday and just see what their thing does.
It's gonna be like a SPAC merger announcement move or something. Maybe even
it's
more.
Gonna be crazy. Yeah.
Or one would think. We'll see. Not investment advice. I have no idea what will actually happen.
Entertainment purposes only. Yeah. I mean the market cap is like under 300 million Australian dollars. So
that'll be a fun one to watch. What, want to vote on it now for the punch card portfolio?
Yeah, should we make our predictions? So the stock price is currently 49 cents Australian. What are we guessing it's going to close out on?
What are we guessing for next week? Oh, it depends. Is this like? Is it official? Are they like they're?
He tweeted it.
I mean,
on Twitter.
It's on the books as a tweet. It's official. All right.
It's a verified account.
Yeah.
There we go.
I don't know. It seems like it'd be hard to guess that at least on sentiment, not a double. But I don't know. I could see it like spiking and then falling right away or something silly.
I'm gonna guess it goes to $1.03.
This is our technical analysis right here.
That's my random guess.
Someone pull up that chart. We'll point at it and draw lines on it, and then we'll figure it out.
Yeah, we'll have to check back next week and see.
That'll be a fun one.
Someone's asking for the ticker. It's BUB, Bub.
Bub.
On the ASX. Yeah. So entertainment purposes only, but that'll be interesting.
That's an entertainment one for sure. Any final thoughts before we wrap up here? Any whether it's related to Carvana or anything or milk or whatever.
Hey, we forgot about Alibaba.
Quick note on Baba. They had good earnings. The market seemed to like it.
So if you search $BUB on Twitter, some people are interested. That's for sure.
Right.
I mean, Joe Biden's holding. He's in.
There's been a suspicious amount of international buying earlier this week.
Could you imagine? The president front runs the deal.
Someone said it would have been nice if he included the ticker.
Who's that? Who's the politician? Nancy something.
Nancy Pelosi, the Speaker of the House. Yes.
Yeah.
She's done very well.
She's got calls. She's got calls.
Massive success options trading. Oh gosh, so gross.
Super investors.
But yeah, any hot takes on Alibaba earnings? You guys listen to the
Oh, I
conference?
loved it. I'm in Alibaba as a temporary position for the Prosus tax loss harvest, going back to Alibaba, and it was great. And it looked positive to me. I was impressed with the revenue growth all around. And then I think I read an article today. They said that, hey, by the way, April is not looking too hot because of all the lockdowns, but we're starting to see things get better. So whether it's Prosus or sorry, not Prosus, but whether it's Tencent or Alibaba, I'm really getting a respect for the way dominant companies with huge moats can survive through really tough times. And China seems to be in one of the toughest times ever right now. So the fact that they had that kind of quarter during all this, I thought I was very impressed.
Yeah.
And the buybacks, 25 billion is the plan or something.
Yeah, but I'm not very
Yeah,
impressed
and
by
they've
the
wrapped them
buybacks.
up
I wish
recently.
they'd done more. Like, it seems quite less relative to what they could have done.
I mean,
That's
still
just
50 billion net cash, I think, ballpark.
yeah.
What's kind of amazing is I think that day it popped like 13% or something like that.
13%, yeah.
But it's still below 95.
Yeah, it's 13 off a small base, Jack. So it's,
yeah, I know.
it's
The
still
law of
down.
big numbers or whatever.
Yeah.
I was impressed with some of the, I don't even know if they make money in some of the line items of their business segments, but some of the growth was like on the logistics one, the Kai Now thing or whatever it's called. A lot of growth.
Here, final thing to wrap up on. Jason, you got to tell us.
Well,
Only if
there's-
you
we
want
were
to.
chatting
No
earlier in
pressure.
the week. I think it's a fine reason if you're willing to share.
yeah. So what happened is I just it's hard to explain, but I just had a total switch in mindset, or I just got a total feeling, like all of a sudden, like an overwhelming feeling that basically said, I'm kind of done doing a couple of these things. I just, with Twitter and YouTube, I'm done, other than Punch Card. I'm going to continue to do the podcast and continue to write a little bit on the website, maybe. But just, I'm going to continue the whole portfolio thing and probably the podcast and probably a little bit of writing, but I'm going to take it old school with audio only and the written word. And it was kind of a combination of good things and bad things. So the bad things with Twitter is I could not turn it off. Like I could not get away from it. Like every time I was trying to work or every time I'm just sitting around my house doing something that's not work, I pull out my phone and look at what's going on. And it was like too much and I just couldn't turn it
Sure.
off. So I was like, I got to get out of here totally. So that was Twitter. YouTube. It was just a time thing. I was just putting way more time than I had available into it. And it was also a content decision. Like I was doing these tea times for a lot of it. I was doing it daily, Monday through Friday, and then I moved to weekly. But they were such an effort and so much energy for some reason. What happened was my skill set as an investor over like the last year doing that, in my opinion, I went on like a rocket ship. And I kind of feel like I'm at a point where now I'm ready to just invest. And I feel like I learned so much and have so much skill in this area that now I want to more so practice it. And instead of doing like a piece of content or worrying about content or all that kind of stuff with the channel, I want to listen to 4 earnings calls of Carvana the other night, or I want to listen to Party City stuff, even if I might not buy it. And I just had that feeling and I was like, okay, I'm done, but I'm still going to stay in touch with everyone. And I'm going to miss that about Twitter. Like I got a lot of good stuff from messages, a lot of resources, a lot of good interaction. I'm going to try to keep doing that where people can contact me on the website. So there's definitely downsides. And like the Brett Kelly thing I saw earlier or talked about with his tweet, I'm going to miss stuff like that. But I had to kind of get out of that. But that's the situation. So
Just so you can focus on the arguably bigger opportunity. Not that there isn't an opportunity in YouTube, but you want to focus on investing. So you want to
well, for me, the opportunity in YouTube was to wanted to just get my name out there a bit, which I've done, but also with the podcast. But
Yeah.
more so, it was like I can't put an amount of money on like the skill set I learned from interacting with everyone and having to
Right.
talk about investing in front of people. But something just switched, and I was like, all right, I'm there. And in terms of knowledge, and I just don't have time for content like that right now. So
yeah, I think that's totally
and
fair.
if we're being truly brutally honest here, I got sick of seeing myself and hearing myself on my like subscription fee. I don't know.
Fair.
I got a little over it. So
that is also fair.
And I would say I knocked it out of the park tonight. If I was a full-time host who
he got sick of himself,
slacking
not
on their
sick of
duties,
himself.
I would be a little nervous right now letting a guy like me on in this form. I'm in my prime. I did a great show tonight, and I don't think I would have brought it like I brought it tonight if I was out there every day or every week still
fresh.
spouting it on YouTube. Yeah, I saved it
fresh.
up for you.
We let him rest. Got
Rushing
fired
it.
up in the bullpen. He's out here throwing gas.
Yeah. Well, maybe
You did
we
great,
need to.
Jason.
Thank you.
Maybe we need to only let you in every few weeks, Jason, just so you can
Yeah, we gotta
really
let
have
him
that
rest.
knowledge overflowing and just
Let it
ready to go.
marinate.
I don't know if you don't let me on here for more than like 3 weeks in a row, it might get kind of ugly in the chat. It's happened before when I wasn't getting calls, and we had some issues in the chat, but that's okay.
Well,
I would
Well,
tell
look,
you guys all seriously. Maybe I sound crazy with the Carvana stuff, but I do think there's a lot to like there. And the question you got to ask yourself is, can they be self-sustaining, or what? Understanding there's a risk of wipeout with the macro until they get to that sustaining point.
Yep.
To me, if you think there is a huge upside here, like there could be a huge upside, I'm not going to use the word no-brainer, but it was a decision like, I can't get away from this thing because I see so much upside. So I'd be curious to see how you guys think about it as time goes on.
The whole different perspective is what makes it interesting. Like, I think we all have kind of been dead against Carvana for some time, I think. I don't know if Brad's like into it, but yeah. So the different perspective really helps bring.
And I had your guys' perspective, like, because I'm coming from looking at a company like this from the same value investing background. But what's so interesting is once I started studying the company, once I started listening to the earnings calls and following the trajectory of the company, comparing that to the crazy comments I see about this company out there on YouTube and on Seeking Alpha and Twitter and stuff, it's such a polarizing thing. And it's just so weird for how it can be looked at from the outside. And then when you're on the outside, maybe as a value investor, looking at other people talking about Carvana and the way they talk negatively about it compared to what I actually saw when I started looking at it. So
it kind of brings me back to the Bill Miller interview, which is like when he was buying Amazon, Bruce Greenwald was telling him, you're not a value investor because Walmart is going to kill Amazon.
Sure.
And
Sure.
And he said people thought Amazon was going to go out of business, and apparently the books on their warehouse shelves were legally allowed to be, they had the right to send them back to the publishers and get their money back. And he said, no, they're literally not going to go bankrupt because of this. And so he bought. That's kind of where I hope I can get to Carvana. If I can figure it out and get to a point where I think the risk of wipeout is like super, super low or non-existent because of some reason, maybe like Amazon buying Carvana for $5 billion and thinking it's a steal. Maybe that's a floor. I don't know. I don't know if if I'm ever going to be able to get there, but if I can get to a point where it's like, wow, the downside's super limited or non-existent, then I'll be able to go up in allocation and participate in even more of potentially the upside. So I'll be trying to get there, but so far I haven't been able to get there.
I think that's a good spot to wrap up. Jason, thank you again. Appreciate you adding quite a bit of color to this Carvana discussion, seeing as though you're now a shareholder. So it's interesting to hear a more bullish take, but obviously you recognize the downside risk, and that's the name of the game. It's weighing the downside versus the upside and pulling the trigger if you're comfortable with it. So regardless, best of luck with it, and we'll keep posted on it.
The march continues. Back to you, Jack.
Exactly, and back to you.
I'm looking forward to some of the old school deep dive podcasts, Jason, even if they're a little less frequent.
Yeah, well, I mean, I'm going to definitely do them because your content is deep dive, and like I was saying, every morning, every night. Good morning, Tom. Good night, Tom. So I'll definitely have the inspiration.
What does your wife think of that, Jason?
She sleeps in a different bed.
I think we were wrapping. Hey, come on, Tom. I've been public on YouTube here for months and months. I'm, obviously just got off of Twitter. Obviously got off of YouTube. I think we're gonna, as Brad says, we're gonna keep it on the company. Okay, I don't want to talk about. I asked the question last week, and he was like, "We're not going to talk about that. We're going to keep it on the company."
Brad likes to keep to himself. He likes to talks about the values much more than than what's going on personally. And that's fair. That is totally fair.
Yeah. So Tim says a comment. She is also a fan, and I think that would be understated. So
they have a poster of you, Tom.
Yeah, you think Omaha was something else? Was
full,
something, Tom? Don't come to Oklahoma, okay?
They have a life-size cutout of Tom.
Yeah.
Wait till you hear what he's got on Quran, though. That's a whole different level.
And on that, we'll wrap up.
With that said, check out the discount links.
Right, do this little thing, guys. Do the
go a long way
Let's
towards helping the channel. Like, comment, subscribe. You know what to do. Discord, if you haven't joined it already, it's always lively in there, especially now with all the turbulence in the market and some good amount of Carvana talk in there too. But until next time, everyone, see ya.